Sensex and Nifty are rallying to all-time highs. Here's what you should be investing in. Welcome to TOI Wallet Talks. Indian equity markets have been hitting all-time highs and India is back in the top 5 global markets club. What's driving the rally and what should retail investors do? Does it make sense for them to diversify into fixed income instruments given the current interest rate scenario? Chatting up with us and giving us insights on this topic is Akhil Chaturvedi of Motilal Oswal AMC. Welcome to the show, Akhil. Thank you for being with us. The Indian markets have actually been rallying and we just would like to understand from you what is driving this current market rally and what is your, medium to long-term outlook? How much steam is left in it?
Yeah, thanks, Smriti. Thanks for inviting me to the show. The markets are in very good momentum and more specifically in the last quarter, we've seen that the markets have started to inch upwards and in fact, we made all-time high now.
Right.
So in general, there is a very good momentum for India as a asset class, India as a story. If you see the narrative coming from the global investors, from the Western markets, if you look at the domestic narrative, there is a lot of optimism about the India story playing out, maybe in the next decade or so. There is a consensus that India will be the third largest economy in the next 7 to 8 years. So we are just about $500 billion away from, Japan and Germany. And next 1.5 years, we should pip them and claim the third position. Now, as that happens, obviously, the economy will be striving and thriving. And as that happens, the domestic businesses will also thrive in the growth momentum of the country's economy. And as that happens, obviously, all the companies in India will benefit both from the domestic growth as well as the international growth side, and which will reflect in the profitability of these companies over time. And that is going to result into their stock prices, inching upwards. And that's the whole story of India, which is playing out, and we are witnessing it. Even if we do somewhere in between 6.5% and you add 4-5% inflation, this year also our nominal growth will be 10 to 12%, which is phenomenal in the current environment where most of the other countries are slowing down, including close by China, US, Europe, Japan. So all of these countries are slowing down and India is growing amongst all of these things. So this is the positive narrative around why the Indian markets are actually looking so good.
Okay, but what is the breadth of this rally? Are only a few sectors and stocks driving it?
So this is now changing. Yes, in the last couple of years, markets have been polarized. So, some years, some stocks, some sectors have done well. Last year, more specifically, value as a style, low PE stocks, they did extremely well. But this time around, in the last few months, we are seeing that the rally is getting broad-based, very, very broad-based. Of course, being led by the entire consumption pack. If you see reality index, that's moving up, consumption, telecom, banks to some extent. So we are seeing that the rally now is getting broad-based, which is where we are seeing that most of the active mutual funds, portfolio management services have also started to do exceptionally well. While last year was a little bit of a stress for fund managers because they were underperforming the market because the market rally was very polarized. But in the last 3 months, more specifically, most managers have caught up. Alpha is coming back, and that is happening because the broad market is looking extremely good.
Right. But Akhil, while the India growth story does definitely look optimistic given the, even the fact that we are amidst global headwinds, but to this rally, what are the biggest global and domestic risks that you can foresee, if at all?
So globally, if you see, we are still in the conflict between Russia and Ukraine. So that is a risk, and it does have an impact on, supply chains. It has an impact on, fear of larger issues, geopolitical issues, etc. playing out. That certainly the inflation has come down in US, but there are still expectations that the interest rates could go up, maybe 50 basis points or so. That is what we hear. If you go into Europe, there inflation is still sticky. And I was just hearing the IMF Gopinath she was talking about keeping a tight watch on the interest rates for the European Union.
Right.
So inflation interest rate in Europe and US is something we need to closely monitor. RBI governor has made certain statements where he's saying that we still need to monitor our own inflation, especially because of the El Nino impact. Monsoon is one sort of risk factor, I would say, because that could have if there is a food inflation there, if the monsoons are erratic, not widespread, that could lead to sticky inflation around food prices. So if all being normal, then I feel that I think after 12 months there should be a rate pause, and maybe after 12 months we should hope to go into a reduction in the interest rate. So we'll watch out for that. Some of the other things would be clearly that not much disruption globally. Indian economy does hold up at 10-12% nominal. And if we sustain the earnings growth, the profitability of the Indian companies holding up in the year, as per the consensus targets, then I think things should be pretty okay for India, at least in the next 12 months.
Okay, and from a retail investor perspective and from a long-term outlook, what should I be investing in? What should my investment strategy be?
Retail investors are allocating their savings into asset classes which can grow their wealth, increase their purchasing power after 10, 15, 20 years. There are many retail investors, obviously, who are investing to buy a home. They're investing to plan for their children's education, child marriage, retirement. These are all goals which are pretty far inside. And when you have that kind of a time horizon of 10, 15, 20 years, maybe even longer for the younger investors, then obviously you have to have a view which is more long term. And in long term, as we see, more specific to India, we all are talking about, like I said, that doubling of economy in the next 10 years. Then we are talking about Amrit Mahakal, where next 27 years, probably India would be the second largest or the second highest growth economy. In long term, markets are like a weighing machine, and in short term, it is like a voting machine. So when you have that kind of a tenure, you have belief in our own country, you have belief in our economy, that will all reflect into the markets, and equities in long term have delivered, we all know, 14 to 15% headline in the last 40 years. I mean, even if we keep a very conservative target of 12-13%, which is equal to the nominal growth of the country, then compounding of 12-13% over 10, 20 and 30 years could have a crazy impact on the wealth which one can create. So to the retail investors, I would sincerely urge to not try and time the market in the short term. I think in short term also things are looking fine, but when you have a view of 10, 20, 30 years, then just simply keep allocating as per your asset allocation model, as per your liquidity requirements. And when it comes to equity, put that much money which you can forget for 10, 20, 30 years. That is how you plan to invest in a volatile and a risky asset class like equity.
There are equity mutual funds, there are debt mutual funds, there are hybrid mutual funds. What are the category of mutual funds that they should be looking to invest in from a 10 to 15 year horizon?
If your goals or if the requirement of the money is, let's say, in 5-year time frame, hybrid funds, balanced advantage funds are a good option to invest in because they come with a mix of equity and debt. So in uncertain times, in this time frame, the debt component will give you the protection, and in good times the equity portion will give you the growth quotient. So for 5 years and below, I would suggest to have a healthy mix of debt and equity through balanced advantage funds or hybrid funds. As you go into your long-term goals, then certainly you can start looking at flexi cap funds, 100% flexi cap fund, 100% equity, but more into flexi cap, and then you can look at mid cap, and and there are a variety of options into mid and small. And then so the longer the liquidity requirement, you should go down in the market cap segment, and shorter the need of liquidity, you should come in safer products like a large cap mutual fund. I spoke about hybrid funds, I spoke about balanced advantage funds. So this should be your strategy while you are allocating money to mutual funds, within that equities. If you do not want to take those kind of risks which are prevailing in equities, you want to park your money for 1, 2, 3 years, you don't want to lose capital, then there are a variety of funds which are available. So under 1 year, you can look at ultra short-term funds, you can look at liquid funds, and then if you're looking at 2 and 3 years, you can look at the income fund category. So from that perspective, debt funds also make a lot of sense.
Is it a good time for me to diversify my portfolio into fixed income instruments? Even gold has been rallying. So what is your take there?
Yes, certainly. There is a medium-term opportunity to invest in fixed income funds. So those fixed income funds having a average maturity of, let's say, 3 years and more. If at all interest rates cuts start to happen after 12 months or 18 months or so, then there will be a rally in the bond prices, because that's an inverse relationship.
Right.
So there is a medium-term opportunity to make above average returns in debt funds. So certainly there should be some component of debt in your portfolio. There should be some component of gold. Now it's very difficult to predict gold, but generally gold tends to do very, very well in uncertain times. The times like we have seen in the recent past, like COVID, or we saw in the war which happened last year. When everything seems to be a doomsday, then gold is what comes out as a protection. So, having a 10% kind of a all-time allocation into gold, or not gold ornaments, but, buying, you can buy gold mutual funds, gold ETFs, sovereign bonds. There are many options available, but having 10%, 15% allocation to gold at all times, not for returns, your returns will be equal to inflation, but simply as a protection towards any uncertainty, any uncertain things happen, which comes out of a surprise and we don't predict it. So it's more for protection.